The 60-40 portfolio says that your investment portfolio should be 60% stocks, 40% bonds. These stock market investments are going to give you the growth. These bonds are going to give you safety and income. Over the last 60 or so years, this 60-40 portfolio was the gold standard of investing portfolios, and it has averaged around 9% growth a year. But now investors are saying it doesn't work the way that it used to. For example, Larry Fink, the CEO of BlackRock, which is the largest investment manager in the world, says the 60-40 portfolio no longer gives true diversification. Now, I don't care if you hate BlackRock or you love BlackRock, the reality is they manage more money than anybody else on the planet, so at the very least, you can learn from them. So let me start by going over the 3 reasons why the 60-40 portfolio doesn't work the way that it used to. Reason number 1 is that stocks and bonds are not negatively correlated anymore. One of the big attractions of the 60-40 portfolio is that in history, when stocks go up, bonds go down. When bonds go up, stocks go down. This way you can make money in any market. But that started to change in 2022. 2022 was the first time in history that stocks and bonds both went down at the exact same time. That 2022 downturn was the worst year in history for the bond market, and at the same time, we saw the stock market fall by around 20% in the United States. That was a warning sign for Wall Street, because bonds have historically been a safe haven, a protection place for investors. That when there's a lot of bad things happening in the economy, turn to bonds. But in 2022, not only were we seeing the downturn in the economy and the stock market, but people were also selling off their bonds. And the reason why is because bonds just don't seem as safe as they used to be. Now, just so we're on the same page, a bond is a loan. And more specifically, a lot of times when people are talking about bonds, they mean lending money to the United States government. Because the United States government spends money it doesn't have. This is our deficit spending that we see happen. This is why we have such a large national debt. And so the United States government borrows money from regular people like you and me, and they pay you back plus interest. Well, because of this huge sum of national debt that we have right now, more and more investors are getting concerned about the United States government debt. They're getting more concerned about the health of the United States dollar. And so the bond market works when people believe in the strength of the government, and the bond market works when people believe in the strength of the United States dollar, because you're not seeing any value appreciation, you're just getting paid back interest in the dollar. But now, because of how much inflation we've seen, because of how much money printing we've seen, because of how much national debt that we have, because of our concerns about the government, because of concerns about inflation and the dollar, people are starting to lose some trust in the bond market, and that's what we saw happen in 2022. We saw concerns about the economy, and people still did not feel safe going into bonds. They wanted alternative assets, and this is why Wall Street and a lot of investors are saying, maybe these bonds aren't as safe as they used to be, because if the markets are going down and bonds are going down, that defeats the entire purpose of the 60-40 portfolio. Now, before I move on to number 2, I do want to remind you that for those of you that are investors, specifically in the stock market, I do have a free investing masterclass where I walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. I'll also lay out the exact framework that my firm and I use to research investment opportunities before they hit the headlines. It's a completely free masterclass. There's a ton of value in this masterclass, and when you register for it, you're also going to get access to Market Briefs, which is my newsletter for investors, completely free, complimentary as a bonus. So if you want to get the investing masterclass and Market Briefs all for free, all you have to do is register, and I have the link for you down in the description below. The second reason why the 60-40 portfolio doesn't work the way that it used to is because bond returns, the money you can make from these bonds, are generally pretty weak. And now with inflation still being a concern, that starts to outweigh the potential return possibility. So remember, a bond is a loan. You are lending money to the United States government, and in exchange, you are going to get interest payments. You're not going to see growth in the value of your principal. You are investing for interest payments, and right now, at the time of me recording this video, if you lend your money to the United States government for 20 or 30 years, you're going to see slightly under 5% in interest on your money. That means if you were to hypothetically invest $100 and you made 4.75% in interest, that means you made $4.75, which doesn't sound bad, but there's 2 things I need you to remember. Number 1 is inflation. Because you're not seeing value growth in the value of a principal, your only return is this interest payment that you're getting right here, $4.75. And right now, at the time of recording this video, the average inflation rate in the United States is about 3%. So you're making 4.75%, but then you're losing 3% of value due to inflation. And then there's concerns that if we continue to keep printing more money in 2026 and beyond, that inflation rates could go back up. There's also concerns that if tariffs pick up more, our inflation rate could pick up again. And then there's concerns that if the Federal Reserve Bank ends quantitative tightening, which they said they're going to do on December 1st, then inflation could pick back up. So you're making 4.75%, but then you're losing 3% to inflation. And also, let's not forget that 3% inflation is the reported inflation numbers. The real inflation that many people feel is actually a whole lot higher than 3%. In fact, the general rule of thumb is that your real inflation is 2 times the reported inflation. So if reported inflation is 3%, that means real inflation that people are feeling is 6%, which means you're actually losing value with this interest that you're getting from the government. But even if we ignore the real inflation, if you're losing 3% of your value with inflation and you're generating 4.75%, you're really only making 1.75% in interest on this money after inflation because the value of this money is not growing. And then there's problem number 2, which is taxes. When you lend your money to the government and you make interest, you have to pay federal tax, but you don't have to pay state taxes. This is one of the benefits of bonds, is you generally don't have to pay state and local taxes, but you still have to think about federal taxes. So if you earn a lot of money, you could be at a higher tax bracket, and now you're gonna have to pay taxes on the money that you make right here. If you're a lower tax bracket, you're gonna pay less money in taxes, but that essentially can negate the value of the interest that you're getting from these bonds, because number 1, you're losing value because of inflation, and number 2, you also have to pay taxes on the money that you're making, which means you might not actually be making any interest at all. Your money's kind of just staying the same. And then part number 3 is volatility on the stock side, because this side, the stock market investment, is supposed to give you steady growth. But what we've been seeing now in the last number of years is that the stock market is much more volatile today than it has been in previous decades. Why? Because of more geopolitical concerns. Why? Because of more concerns about inflation. Why? Because of all the money that's been printed. Why? Because of concerns about the national debt. Why? Because of artificial intelligence. Why? Because of all these political changes that we're seeing happen all at the same time, which makes the market more volatile. Now, yes, that creates opportunity for the financially savvy, but for the average person who doesn't want to do the research or put in the work, that makes investing a whole lot more scary and a whole lot less predictable. And this is why you have a lot of institutions on Wall Street saying maybe the 60-40 portfolio isn't right. Maybe we need to add in more asset classes like alternative assets. Maybe we need to start thinking about gold. Maybe we need to start thinking about different types of investments like crypto that we can mix into the portfolio, that we have real diversification. So let me break this down with my personal opinions. And again, these are my opinions based off of things that I do. I don't recommend what I do to anybody else, but I just want you to start thinking like an investor. That way you can build a better portfolio for you. That way you take better care of your family. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.